Eurozone debt resurfacing, the Bank of Spain taking over Spanish bank Gilmour. What does it say about the banking industry in Spain?
Do you know, in my experience, the banking industry in Spain is actually very well run. And if I think of the big banks like Banco Santander, for example, I mean, that came out of the global financial crisis really incredibly well and in exceptionally good shape. So much so that it was buying a lot of other banks in the UK, banks like Alliance and Leicester and Abbey in the UK, for example, which, by the way, are now changing their names to Santander to fully reflect the ownership there. So I think this may hopefully be seen as an isolated incident. It's interesting if you look at the US. I mean, there you have banks folding literally every week, literally. The government doesn't bail them out. That only happens if you have banks that are too big to fail, like Citibank and Merrill's and organizations like that. So I think we must just get a little sense of perspective in this whole thing, that perhaps there's a lot of nervousness in the Eurozone about all sort of banking institutions and like at this point in time because of the Greek situation. Perhaps some of them have had loans into Greece, but I don't think an operation like this would have been too badly affected by that.
All this nervousness on the global economy, this uncertainty does put some sort of opportunities on the table. Is it time to put your money on the table at the moment?
Do you know, again, in my experience, when you have this kind of this degree of volatility, and it's huge, it's probably better to let things settle down and really see where economies are going, where markets are going, before you jump in. Because, as I say, with this degree of volatility, they could go down further. I'm not saying they are going to go down further, but it's quite possible, because when you get a market like this, which is influenced by fear, all you need is the slightest thing to drive it lower again. So I would tend to sit in my hands and see what eventuates over the next few weeks.
So as an investor, where do you hide?
Well, it's very, very difficult. I mean, I think, you know, a lot of people now are looking at cash. Obviously, this is a parking bay, because you're never going to get rich putting your money in cash or near cash. So I think it's probably as well, you've done your homework, you know where the good companies are, you set a price at which you want to get in, and if that price comes around, you have a look at it very, very closely.
If we bring it to the local front, economic GDP out later on today, 4.3 in the first quarter. The supply side of the economy likely to push those numbers up.
Yeah, and you know, if we look at the demand side as well, we're starting to see indicators like retail sales, for example, going positive for the first time in, 14 months. So I think supply side looking good, demand side looking increasingly better. Generally speaking, our economy is looking reasonably good. We're not getting back to the 5 and 6% growth that we had a couple of years ago. Sure, that's going to take time. But I think in terms of longer term sustainable growth, looking reasonable, and I think these figures coming out hopefully aren't going to disappoint.
Okay, at 4.3, can we really sustain these levels given what's happening in Europe?
Bear in mind that's 4.3% quarter on quarter. You know, year on year annualized, the figure is going to be a lot lower than that, probably in the 2.5% range. And I think that's a much more sustainable type of figure for the year as a whole. So I wouldn't get too carried away on those kind of figures.
All right, and we've got consumer inflation out on Wednesday and Thursday. We've got producer price inflation. Consumer inflation is expected to stay within the target band. What are your expectations on that front?
Yeah, we're looking around about 5%, which is, you know, well within that 3 to 6% target range. It's going to be interesting over the next few months to see what actually happens on the inflation front, because there are many extraneous factors beyond the control of the Reserve Bank that may start pushing inflation up. I'm thinking here mainly of administered prices. And later in the cycle, second round effects coming in from higher wage increases. You know, so that's going to put pressure on. Now, it'll be very interesting to see what stance the new governor of the Reserve Bank takes with respect to this. I'm pretty sure she will not get deflected. I mean, she's made it pretty clear. In fact, she's made it very clear exactly where she stands on this. You know, I don't think we're going to see interest rate hikes when they do come until about probably the second half of the end of the first half of next year. Yes. So I think we're probably looking at relatively stable interest rates with no reductions between now and probably a year out.
We talk about the outlook for inflation. We've got Tatu and Satawa demanding like 11% on those are above inflation wage increases, and you've got Eskom looking at 18%, really going to affect the inflation outlook going forward.
That's the problem. And if they're successful in getting these wage increases, then the monetary authorities run the risk of letting inflation get what they refer to as being unanchored. In other words, you have so many forces coming into play, extraneous forces, that you literally have no control over whatsoever in terms of interest rates. Although wage increases, you know, that would tend, if they got those kind of things and that started snowballing throughout the economy, then, and if that of course ended up having an inflationary impact from a demand perspective, then they've got a good argument to start hiking rates further and faster than would otherwise have been the case. Other extraneous factors like the administered prices, like electricity increases, that type of thing, they've got less control over.